Hey, what's going on, Cashflow hackers? It's Chris, Life 180, and today on this live video, we are talking about why now is the worst time in history to buy an IUL. Now, getting into this, I want to just kind of get into it and give a little bit of a background on why I'm doing this video. Recently, I've been having a lot of people reach out to me. I mentioned this a little bit in my other video a couple days ago. The fact that so many people right now are pitching IUL. I mean, IULs, I think, grown to be one of the most common sold products in the world. People ask me all the time, like, why do you have to spend so much time focusing on IUL when you don't sell IUL? And, you know, I just had an interesting conversation with an RVP of a company, regional vice president of a company that sells IUL and whole life. And it was kind of a fascinating conversation just to like realize that, you know, it's just there's so many different reasons that, to me, I mean, we didn't get into this in this call with him, but like as I was kind of working through all the reasons that I didn't like it and rehashing my background and my history and in the IUL space and the conversations that I've had with people and kind of doing what I do and why I do it and all these things, getting to the place of realizing like, wow, this is so important. You know, people think that I just like to bash on IUL. I want to start this video by saying the intent of this video, even though I'm going to come across passionately, even though I'm going to be really intense at times, my intent is not to bash IUL. Hey, what's up, Jonathan? My intent is not to bash IUL. My intent is to educate. My intent is to share with you what I wish I had known before. The things that I had wished somebody had shared with me that would have saved me half a decade of my life, half a decade of my career, all these things. And that's why I'm so passionate about this. Now, people keep saying, I mean, there's this Facebook thread going on right now. Hey, baby. Hi. You just say hi.
Hi.
There's a Facebook thread going right now. And in the Facebook thread, you know, a bunch of people, a bunch of, what?
Can I go swimming?
Is there an adult?
Yeah.
Okay.
There's lots.
Lots of adults?
Yes.
Go ahead.
Thank you.
Yep. So, sorry, I'm in my studio up near the pool at the hotel, and it is what it is. I get bombarded sometimes, but there's a lot of people on the thread that were saying, why don't you just focus on whole life, not IUL? I'm going to tell you right now, the reason for me is that as long as I know one person has the opportunity to watch this video and it can save them, then I'm going to keep doing it. I really don't care if like 1,000 agents want me to just focus and stay in my lane, so to speak, focus on the positives of IUL and not the negatives of IUL. I don't think you can have one without the other because I think the challenge is, and I'm going to start with that actually. I think one of the challenges that I have in this whole deal is the fact that, like, if you look at the history, actually, let me do this. I don't want to get rid of that and take a chance of ruining it. I think this is an important thing to understand. The challenge is so life insurance companies have been doing this since 1840-ish. Since the 1840s, we've had whole life insurance companies, or like participating mutual life insurance companies, right? Participating mutual life insurance companies since the 1840s. So when you put your money in a whole life policy, you are partnering with them. Okay. What happens is in 1997, after however 150 plus years of success from whole life insurance companies, along came the IUL. Now, from 1997 through 2009, it was kind of crickets. There was really not a whole lot going on. Their market share of IULs wasn't really great. So a lot of people will say, oh, well, IULs have their place. IULs are created for something completely different than whole life. But the reality is IULs were not created differently or for income or anything like that. It wasn't until 2009 that somebody got a marketing idea and said, hey, let's revive this product. And they did. And the marketing behind the concept sent the product soaring through the roof. That's it. But here's the problem. Fundamentally, what I have a problem with IUL is that they use the success of whole life insurance companies from 1840s, and they try to position it as like, why don't you put your money with a life insurance company? Why don't you put your money there? They've been successful for 180 years. And they say, like, people like Ray Kroc, Disney, J.C. Penney, You get the gist. If you've done any watching on the marketing on this, the Rockefellers, all this stuff, people will say that, you know, this is why you need to use an IUL, because people do this. So what they've done, IUL agents have bastardized the success that all these people have used whole life insurance for over that time. And you don't realize that it doesn't matter, because when you have your money with an IUL, the insurance company, you are a profit center to the insurance company versus a partner with the insurance company, right? And that is a wild difference. And the reason it's a wild difference is because with whole life insurance, my board froze up. But the reason it's important is because with whole life insurance, everything's resetting on me here. Yeah, it froze up on me. So I got to reset my board for a second. So the reason it's important, it's been doing this on me. I don't know what the deal is, but I got to restart it. I'll be back to it in a second, but I'll talk to you for a sec. So the reason it's a big deal is because with whole life insurance, if you put your money into a life insurance policy with a whole life insurance company, participating mutual whole life insurance company, you are going to be successful as long as the company is successful. The reason we're utilizing life insurance companies isn't to take a lot of risk, isn't to get massive returns. It's to keep our money safe. It's to keep a financial foundation to our life, right? That we know is going to be predictable. We know it's going to be there. We know it's going to be measurable. We know what problems it's going to solve, right? Like that's one of the reasons that we're doing it. When we put our money into an IUL, we take all that benefit away and we put it into a speculative product that provides, you know, potential growth maybe and all these things. But the reality is it's super risky. My board is not restarting. It's driving me nuts. And so that is what it is. You're taking, it's super risky. And so these people go and they market IUL like all these people have used them and that they're all successful, when the reality is these people that they're using to market IUL, the JCPenney's, the Ray Krocs, the Rockefeller family, all that stuff, they all used whole life, right? They would never use IUL. It doesn't perform the same function. It doesn't provide the same attributes and benefits, and so they wouldn't do it. And now, to get into this, why in the world is my board not turning on? See, guys, this is what happens when you go live sometimes. Let me see here. Maybe it's just restarting, resetting. I'm going to plug it back in. How about that? Maybe that'll work. We'll see. But I hope that makes sense, because that's a big deal. Now, what I'm going to do, yeah, we got the board going again, so hopefully it'll sync up better. But here's the thing. When we look at this, what I'm going to go through today is when we think about the reasons that it bothers me. Okay, I just shared that. That's great. But then on top of that, right now, we go from 1997, right? And we go from 1997. I'm going to pull this up. We go from 1997 to 2009. There was like no market share. And then we go from 2009 to 2020. And the marketing became crazy. And so in 2009, there were literally 4 companies. And now in 2024, there are 70 plus companies selling IUL. And the reason that happens is because of the marketing. These products were not designed for tax-free retirement. A guy named Patrick Kelly came up with the idea that it was a good idea and a good way to sell it. And that was it. And then it was sky was the limit. Some companies took onto it, and as a marketing concept that they started shifting the way that the products were positioned. Okay. That is just, that's the reality of the situation. Okay. And so now when we look at this, now I want to go down here and I want to talk more about where in the world did it go? Oh no, did I lose my thing that I built? I had a whole customized, that's really sad actually, because I put a lot of time into that. Oh, right here maybe. I don't know. No, it's not it, but it'll work. It'll work. This is not the one I was thinking of, but it'll work. So here's the deal. What I want to talk about now is the fact that when we're in this environment right now, we just came through the greatest bull run of all time. I created the IUL challenge to simply show people that index universal life is, if it can't provide upside protection or upside potential in the greatest bull run in history, what's it going to do after the fact? That's the case. And so I've had hundreds of thousands of watch hours and time of my IUL challenge videos, and not one person has stepped forward to actually win the challenge. I get a lot of people that chirp into the comments and tell me that they can win, that they have a policy that wins. I had a guy the other day, he's like, oh, it's funny, I've had my policy 12 years and I've been getting 12%. I'm like, that's fine, show it to me, and I'll give you $2,500 bucks. 2,500, that's it. Like, if you could show me that one thing, I'll give you 2,500 bucks. And he's ghosted me. So it just goes to show these people like just talk, unless they just don't like money. I don't really know, but there's a big disconnect for me there, right? I have somebody in my DM that can show an illustration in force over 10 years, supposedly. Yeah, exactly. Supposedly. You have somebody in your DM that can show you an illustration in force over 10 years that's outperformed its original illustration. That's the question. I'm happy to review it together with you, Jonathan. So that's the thing, though. He says but you need the original and you need the in force, because you got to see what it's compared against. Because once again, the biggest thing in personal finance is not did it do well or did it do bad. It's compared to what? How did it do well compared to what you were thinking it would do? Because I could show you illustrate. Oh, it's a WFG guy. It's definitely a scam then. I could show you an illustration that, you know, went through the roof, and I could show you how it still performed well. So let me use this example. Okay, I'll use this as an example. Okay, and I'll come back to this in a second. I could show you an illustration that was run at 9%. We ran it at an assumption of 9%. Okay. Is the IUL assumption, okay? And so maybe the assumption was 9%, but the reality is 7.5%, okay? And so the answer is 7.5 bad? No, it's not bad. Like, you know, there are definitely a lot of assets that you could have that would be worse. But the question is, when it runs at 7.5, what are the impacts on the net amount at risk, the cost of insurance, loan charges? What are the impacts on the cap rates? You know, like what's actually the net? What's the net result of everything based on the fact that this 7.5% compared to the 9%, how does it impact the overall policy performance? Because it has a big impact, because you might not realize it, but 7.5, 9 minus 7.5 is 1.5%. It doesn't seem like a big deal, but that's actually almost 20% of a reduction. Right? Because it's like, I guess 17.5% or something like that. But what, you know, it's a big deal. And that 17.5% reduction in performance leads to increased charges every year, and those charges compound you. And so over a period of time, that little shift, we say compared to what, leads a big deal in the actual performance of the policy, right? And so, yeah, the insurance agents hacked my board. Exactly. That's amazing. But we got to run it again. And so here's the deal. This is what I want to do now. Like, we're in this environment right now where the economy is at this weird timing, right? I talked about this the other day on my live. I call it the anomaly economy right now. And the reason is because, historically speaking, there are certain metrics, there are certain things that happen when things like interest rates going up. If you understand Keynesian economics, the goal of increasing interest rates is to suck money out of the economy, right? So we pull money out of the economy. That either levels prices off or reduces prices because we got runaway inflation. That is the idea of Keynesian economics. For those of you who are not super familiar with it, it's the idea of having an elastic currency, right? Meaning the Federal Reserve, which is a private bank, and there's no federal nature to it, and there's no reserves. It's just all money that's printed, but that's a different video. But the Federal Reserve has the ability to manipulate interest rates, to increase them or decrease them based on the overriding economy. When things get really tough, what's up, New Rich U? When things get tough in the economy, theoretically, the Federal Reserve has the ability to reduce interest rates, therefore stimulating the economy because it makes the cost of goods cheaper. That's supposedly, hypothetically, and it does in real world implication, stimulates money into the economy. Conversely, when you raise interest rates, it makes everything more expensive. And so therefore that extra expense goes to the Federal Reserve. It trickles up to the Federal Reserve. They take that money out of circulation and it reduces prices, or it levels them off and lets the real economy catch up, so to speak. And so that's the problem, right? So we are in this environment where these typical ways of being are no longer making sense. And so what's happened is the past 3 years, IUL agents have kind of like had a get out of jail free card, where the economy was bailed out by stimulus, by COVID funding, by whatever, I don't even know all the things, all the programs that were implemented where people were getting free money and stimulus checks and forbearances and all these different things that made it so asset prices and investments and everything just kept going up. And I think if anybody that watches it, and this is the interesting part to me, I think most people that sell IULs would look at this, because let's face it, most people that sell IULs are selling it as an alternative because they hate 401ks, right? The challenge is now, if you are the person that hates 401ks and you love IUL because you don't want the government and you don't like taxes and all these different things and government debt and all this stuff, like if that's you, well, then you probably are concerned about the future of the economy. You're probably looking at it through a lens of being like, okay, you have a lot of discomfort about what's going on. The problem is you just don't understand the moving parts and the inner workings of IUL well enough to be able to like understand what you're doing is actually sabotaging you and relationships that you have, because these things are going to end up being complete atrocities, right? Because they will have problems. And I'm going to show you behind here that there are principles that will come out and play, and they're not negotiable, right? And what's happened is some of the people that are agents that have been, yeah, Jeff, I got you. Sorry, bro. But there are people that are, selling these IULs that don't realize, and they're talking about how good the last couple of years and how I'm wrong, right? And a lot of people are coming out now like, oh, Chris, you're wrong. Cap rate, you said caps were going to go down. Caps went up. So like the part that bugs me is the simple-minded nature of people, where they just look at that actual result on a short-term basis like it matters. The reality is you're looking to sell somebody an IUL from a long-term perspective. So to look at a short-term result inside of an economy that you, outside of your IUL bias, that you would look at it and be like, whoa, this economy doesn't make sense. How are we printing money, and is debt going up from a national deficit perspective? How do we have such a big national deficit? How is our federal debt going up? How is consumer debt going up? How are PE ratios for all the publicly traded companies the highest they've been since 1929 in the Great Depression? How is all this happening, right? And yet still the economy still keeps going crazy, right? Like it makes no sense. It's why I call it the anomaly economy. This is not something that principally can go on forever. And this is a bubble. Like all bubbles, they burst, and it will be a matter of time. I'm not a doomsdayer. I'm not somebody who believes it's all going to fall apart and the sky is falling and all this stuff. But I do believe we will have a massive correction and we will have a recovery from there. Now, that said, this is what I want to say. It's like most people understand that. And so the challenge is this. And what I want to do is I want to talk about some basic economic principles, because I don't think if you can't understand these economic principles, I don't think you should be selling IUL, first of all. So let's just talk about this. So interest rates right here, fixed market interest rates. So we're in a situation, this is what I want to talk to you about right now. We have three things that can happen. The federal funds rate, i.e. the cost of money that trickles down through our economy. The federal funds rate can either go up, it can go down, or it can stay the same. Is that fair? Do I have anybody here that would argue with me that the federal funds rate can either go up, down, or stay the same? Those are the only three things that it can do, okay? And so this is what we have. This is the metric that's going to drive all the things in the economy. And when we look at Keynesian economics, this column is the foundation. This is the column with Keynesian economics. This is the thing they use as the lever to control the economy. And in the simplicity of it is they think that by having your hand on the lever and being able to increase interest rates when needed, reduce interest rates when needed based on economic factors in the economy, it would be good. But the problem is now we're having things that have happened in the economy, like the bond market lost and stocks lost 2 years in a row for the first time in history. It had never happened once in history. Now it's happened twice in history, right? Back-to-back years it happened. And so that's a really big challenge. And so what we have to look at is now we have to do this. I have to go over here, and I know I do this a lot, but bear with me because this is a really big part of the story. So even if you know it, I just want you to hear this in sequence, right? Because it's really, really important. So we have to understand how IULs participate in the market. How do they participate? So here's what they do. You pay your premium, okay? You send it to the insurance company. They're going to take this and they're going to say, all right, you have a cost of insurance. And let's say you have a $11,000 premium. Okay, you have the cost of insurance, and then you also have a cash value. So what's going to happen is, out of the cash value, let's just say, I'm going to say that you got a really, really great agent, and this is actually, I don't even know if they could do it quite this good, but out of the $11,000 premium, we're going to say that $1,000 goes to cost of insurance, and $10,000, just because I want to keep my numbers round, I'm being selfish here, goes to the cash value. So what's going to happen is, out of this cash value, it goes to the general fund. The general fund gets a rate of return. Let's call it 5%. This 5% is what's known as the options budget. Okay? So what this is saying is we're going to take, and this is how these companies give upside potential and downside protection. If they can get 5%, it's basically saying out of this $10,000, we know that we can get you $500 of a return. So we're going to say the options budget is $500. Okay. What happens is they go and they say, all right, we have a $500 options budget. Okay. What are we going to do with this $500? We got to go buy call options. Okay. So we're going to go buy call options now. And how are we going to go buy call options? Well, now we need to know, what is the cost of call options? And this is where it gets interesting, right? Because as call options get more expensive, it comes into a place. So the call options right here, call options are supply demand. The price of options fluctuates, okay? So you have multiple things that come into this. You have the options budget, which is i.e. the fixed market, this 5%, what they know they can get for a return in the general fund, because this leads to the options budget. And then we have the price of call options, because they're going to buy call options. But what I'm saying here is, if all things fixed, if we had a fixed $500 budget, and let's say the call options were $1 each, let's just say, this is not how it works, but I'm just trying to say, then you would get 500 options, right? But if the call options went up to $2, right? If the call options went to $2 and they doubled, well, now you only get 250 options. And so that's going to impact the pricing of everything, right? And so that's not how they work, but that will teach the principle and the concept of how the overall philosophy works. And it's important to understand how that flows, how that functions as we go through here, as you consider how this is working, right? How IULs actually flow, how they create returns, how they participate in the markets, how they are, basically how they are risking this. And this is how it goes. Like, what's happening here is, with this, they're taking this 5%, they got the $10,000 right here, and they're basically saying, all right, we can get a $500 return. And so what's happening here is they say, all right, if the $500 comes in, then you're going to win. And maybe that's a 10% cap. So up to 10% of what the market does, we'll give to you. And if it loses, well, then you lose it and you still have your $10,000. That's how they give you upside potential and downside protection. This cap rate that they give you is all based on the call option cost. It's a combination of what's the budget, what's the option cost, and that's going to be like, what's a cap rate price, right? And so Bobby Samuelson runs a great blog on what the current, or called Life Product Review. He does a lot of different stuff, but on there he does this index talking about what the cost of a 10% cap is across the board with all the different variables. This stuff is really complicated, right? But people sell it like it's a simplistic financial solution to everybody's problems. And that is where my problem with the product comes in. People are selling something they don't fully understand. Now, so going back here, we talked about this. The federal funds rate will change these numbers. Okay, that's cool. Fine. Now let's talk about this. I'm going to talk about the three different scenarios. They can raise rates, they can reduce rates, or they can keep the rates the same. I think most people right now would be saying, I don't think keeping them the same for long is even on the table. They may keep them the same for a little while longer, but ironically, the longer they keep them the same, the more anxiety is being driven into the economy, the more uncertainty is being driven into the economy. Yeah, and Jonathan, that absolutely plays into why there's a surrender period for so long. Really, because they need to have control of your money to be able to do this stuff, right? Like the insurance companies, when they're playing this speculative options game over periods of time, they have to be able to control all the moving parts of the policy, and they have to have the timing of everything. And it really is just a control thing. Remember, when you have an IUL policy, you are a profit center for the company. That is it. And so with the fixed markets, let's just walk through this. What happens if the federal funds rate in a historical economy, traditional economy, not this anomaly economy that we're in, because remember, we've been living in this economy where interest rates have gone up and so has the stock market. It's never been like this before. 120% is actually low. I mean, Allianz, their Pro Plus, their whatever, Accumulator Pro Plus, whatever the heck product that is, pays 165% commission to top level agents. It's crazy. It's crazy. It's so, and I'll touch on that in a little while. But so if the federal funds rate increases rates, what's going to happen? Well, the options budget is going to go up, because if they increase rates, that means insurance companies are going to be able to get a higher rate of return with less risk in the general fund, right? So that's a positive for IULs, right? Because if the fixed market goes up, the general fund performances will inherently go up. Guys, I want to impress this really quickly. So I've been talking a lot about the fact that I believe whole life insurance will outperform IUL net over the next 10 years. And this is the big why. Because as the options budget goes up, so too does the dividend of the insurance companies, right? Because that's how it goes. And so right now, I'm just going to give one carrier. Right now, I have a carrier that pays a 5.2% div, right? It's the lowest in 80 years, okay? And so the crazy part is when we look at this 5.2% dividend, it's the lowest in 80 years. And now I run an illustration. When we run a current illustration versus an IUL and a whole life policy, a current illustration with an IUL is assuming all these different parts, and there's this whole spreadsheet that we got to look at, and there's all these levers that the insurance company can move, and the cost of insurance and all these things. The only thing I can guarantee you about a current assumption with an IUL is that it's not going to be close. It's probably going to perform less, and you're not going to know what you're even looking at the end of the day, right? The thing with a current assumption on a whole life policy is that it's assuming two things. A, that the dividend is not guaranteed. So that's why it's called the current assumption, not the guaranteed. And that's what IUL agents are like, oh, well, you can't compare the current column of a whole life policy. You can't lean on that if you're not going to lean on the IUL current assumption. That right there, every time I hear that comment, tells me they don't understand what they're talking about, and they don't understand the dynamics of either product, frankly. And so when we look at this, what they're saying is that they're going to pay a dividend, which, by the way, we only work with companies that have done this 120 plus years consecutively, never missing a dividend payment. So when you look at the current assumption in a whole life policy, it's that, and it's 100% of current dividend scale of the current div scale. Okay. So when we look at it like that, it's like, all right, do I believe the insurance company is going to pay a dividend, right? Well, this company has been doing it 120 plus years. Why? They paid it through the Great Depression. They paid it through the dot-com bubble. They paid it through COVID. They paid it through all the wars, World War I, World War II. They've paid it through Vietnam and the Korean War. So why would they not pay it now? Hell, they paid it through the freaking Civil War if you go back to the 1860s, right? So why would they not pay it now? They're gonna pay a dividend. That's what these life insurance companies do. If I got news for you, if a participating mutually held whole life insurance company doesn't pay a dividend, we got a lot more problems to worry about than our whole life insurance policy, okay? Or than our life insurance policy in general, okay? And so then it's saying it's 100% of the scale, right? So right now I can look at a whole life policy and be like, it's the lowest scale. These illustrations are the lowest that they've been in 80 years. So I can, with confidence, no guarantees, obviously, it's not a guaranteed column, but with confidence, I can say, you know, I think it's going to perform better. Now, it's not a matter of, is it going to be better or is it going to be worse? You hear me use the phrase, I want to align my money with my values and beliefs. If you think interest rates are going to stay elevated like they are now, or stay the same like they are now, or potentially go up, or at least not go down to the levels that they were for the past decade before they started bumping up with inflation, well, then I got news for you. If that is your belief, then there is a real high likelihood that the policies that you look at when you look at a whole life illustration, it's actually going to outperform what you're looking at on the illustration because it's based on these variables. And it's as simple as this. It's as simple as this. All the IUL agents like to bang on whole life because there's no transparency and it doesn't list off the cost of insurance. That's a really fancy way of saying IULs have to put all that on there because they're all variable pieces of the policy that can move. And because they can move, because the insurance company controls them, and because they can change them on you to their benefit and your detriment, they have to make that acknowledged to you so you can see it. The whole life insurance, the only thing they have to do is say, all right, we're going to do this. Current assumption, if we pay you a dividend, it's going to be based on this dividend scale. This is what you get. It's so much more simple to understand, right? And so when we look at this, it's like it becomes a no-brainer. If you believe these rates are going the way that we're talking about, well, then you, like me, believe that there's a really high likelihood that the policies will outperform what you're actually being illustrated. Whereas I look at an IUL illustration and I would bet money that if I were a gambling man, quote unquote, that the policies are going to underperform the way that they're illustrated because that's what they've always done. Now, getting into this even more, when we talk about, you know, this options budget now goes up. So like I said, that's a positive thing. What happens when the options budget goes up? The options costs go up. Remember, because I went over to there, is like, okay, the options budget, options cost, right? When we go over to here and we go over to here, the options budget is here. But then we go into this situation, right? If the cost of an option is that, well, if the cost of options goes up, we buy less options. This is a really extreme example, but I'm just using it to kind of show you what I'm talking about, right? So, but if what happens is because options are a supply-demand product, the cost of options typically goes up with volatility. So what happens is when you get a benefit of the increased options budget, which will benefit a whole life policy every single time and will benefit the options budget, that they're taking that benefit away and they're taking it and putting it into options products with volatility, which the cost of the increase of that of the options could negate the benefit of this. They could cancel each other out, right? That's not a good thing. So the question is, like I was talking about the cap rate cost, what is the cost of that? The answer is, I don't know what the cost is or like how it's going to perform. It depends. In this anomaly economy, the market kept going up. You know, how much will the options go up? I don't know. How much will they? What index are we participating in? And I don't know what's going on here. Hold on one sec, guys. My kid. What? Can I have your phone? No. Okay. Love you. So sorry, I got interjected by my 5-year-old again. And so what happens is we don't know what's really going to happen. I mean, there is no guarantees. It's just important. This is why I try to tell people, like, I get beyond the illustrations and start to understand the moving parts behind the scenes and understand not just what happens, but why it happens behind the scenes. Because when you look at what's happening behind the scenes, that's what really matters. You've got to align your money with your values and beliefs. And I think when most people look at this from a beliefs perspective, they're going to be like, whoa, I didn't realize even what I was doing, right? And so what happens, so the par rates and the cap rates, they could go up. Let's just say that when the fixed market goes up and options budget goes up, let's say that doesn't have a negative effect. And let's just hypothetically say that the cap rates go up. Let's say they go up a little bit, because I said they would go down. Historically speaking, they will go down. But I've had people tell me, oh, Chris, you're an idiot. You're wrong. The cap rates have gone up, and we called it, and you're wrong. You and Bobby Samuelson are idiots. So funny. Well, so then what happens? Well, this is where the anomaly economy comes in, is that long term, this, I say, depends, because short term, I don't know what's going to happen. The dividend, it can go up short term because we don't know what's going to happen with the cap rates on a short term. We don't know how it's going to impact on a short term because these little blips of 2 and 3 years happen. But the bottom line is, as time goes on, the inevitability here is that it's not, it depends, it goes down. When you have increased interest rates and options budgets, and what happens is the cycles, interest rates are not this linear thing that just go up and stay. Interest rates go up and down, up and down, up and down, up and down, down and up, bump, bump, bump. And so it's, you ride these cycles up and down, right? And you have to understand that. And so it's not like the market goes up and down, period, and it just stays there. So it's like, we have to look at this once again. We're making the decision or non-decision to buy IUL or not buy it. Or if you're thinking and contemplating between IUL and whole life, what you're trying to do is you're trying to figure out what is going to happen from a long-term perspective. And in this scenario, you're talking, you're going to have all these ups and downs. And that's why I'm going through what happens when they go up, what happens when they go down, what happens when they stay the same. Because you realize in any market, it's not good, but especially in today's market. And the reason it's not good is because equities and the indexes are too high. So what happens is they have to come down. So as we have, when we look at the stock market performance, it's going to go down, right? The stock market performance is going to go down, and there's no way around it from a long-term perspective when interest rates go up. Because why? Because of this thing called Keynesian economics that I was talking about before, right? When we look at Keynesian economics, it is the inflation thing that I was talking about before. When you inject money into the policy by reducing rates, you put more money into the economy. When you increase rates, you pull money out of the economy. What does pulling money out of the economy mean? It means you take value out, meaning asset prices go down. That is it, XYZ. Like, it is not more complicated than that. Thanks, brother. Haha, exactly. Friends don't sell friends IUL. That's what I'm talking about. And so here's the deal. Now let's take a look when they go down. A lot of people go, oh, well, you know what? I'm going to say when interest rates go down because of this Keynesian economics thing, it injects money. Mortgage rates go down. So asset prices go up, right? People have more disposable cash. So they have more investable cash. Businesses can take more loans and leverage more. They're more likely because the cost of money is cheaper. So what happens? Stock market goes up. Pricing valuations go up. That seems like it'd be a really good thing, right? And so cost of options is pretty level because there's not a lot of people doing it. There's not a lot of volatility when everything's down. People don't want to take a lot of risk with options when the markets are not super volatile all over the map, which is what happens when interest rates are going up. And so what happens though when the fixed market goes down? Well, now it's bad for general funds, right? Because now the cap rates go down. The budgets, option rates go down, and so the cap rates go down, period. And so even though the stock market can go up, the downside is I'm trying to think, my daughter keeps coming into my office right now while I'm working here. But the downside is when the cap rates go down and the market goes up, if I bought a product with a cap rate at 12% and then the market goes down, and this is why during the greatest bull run of all time, the market did not perform well. And it's one of those things, not the market didn't perform well, the market performed well, but the IULs didn't perform well because people were buying IULs with a 12% cap that illustrated really high, but by the time they got to the end, they were 7.75 to 9%, right? Not because the market didn't do well, but I got news for you. If you bought a product with a 12% cap and now the cap, the best it can do is 9%, I don't care about the 0% floor. My buddy Tom Wall always says, if zero is your hero, then the cap is the trap, right? If the zero is a hero, the cap is the trap. And when the cap goes down in this decreasing interest rate environment right here, right? When the cap goes down, that literally puts a ceiling on your policy. And so if you think about it, the highest you could ever do with these policies that have averaged 7.75, or like they were illustrated at 7, 8, like if you have a 9 max year and you have 1 0 year, that's a 4.5% average. That's not very good. It's really hard to make up for those 0 years if you don't have a cap that's that high. People don't realize that. And so at the end of the day, the market can keep going up. And guys, this is why nobody's won the IUL challenge right now. And the last 10, 15 years has shown the fact that even in a decreased interest rate environment, with the market going crazy, the market's going up, but because caps kept getting reduced, the IUL policy is going to be down. It's going to be bad, right? And it's going to be worse than expectation. So right now, once again, I want to kind of circle back around. Yeah, they can change the caps anytime, man. Anytime. They can change them anytime. So before I keep going on this, let me read a couple comments just to make sure. My cousin's girlfriend has an IUL and she has to pay an extra $38 a month to keep her policy in force. And I told her, told her because the older you get, the higher the cost of insurance, along with the fees and gains. Yep, that is true. All because we're in a recession. Yeah, I mean, it's dangerous. I mean, there's probably a lot to it. I don't know what her premium is. I don't know, what it was originally, what it was scheduled to be, but that's all the case. I mean, it's all dangerous. And so, then the last one I want to talk about, and guys, if you have any questions on this, like what I'm talking about, I'm going to take questions, like a Q&A kind of session in a couple minutes, and we'll get into it. But now the rates can stay the same, right? And if they stay the same, then the options budget is obviously the same. The options cost could be same or higher. That'll be driven by market volatility and supply and demand of the options, right? Cap rates of costs are going to be same or higher, because even though the options budget will remain the same, the options cap rates in a level interest rate environment, the options costs are going to be dictated, or the cap rates are going to be dictated by the options costs, right? Does that make sense? And so then from there, now what we have is like, all right, if the interest rates stay the same, what's going to happen in the economy? I don't know. It depends, right? But over time, if you don't have a market that is indicative of higher growth, meaning the market is going up with the environment where the cap rate is guaranteed or highly likely to stay in a certain level, well, then the performance of the IUL is going to be down. And so right now, the problem is that I don't see this happening, right? I don't see this happening at all. Like I'm just going to highlight it, but I'm saying this is not going to happen. We're not going to have the same interest rates for much longer. What I see happening in the economy is they're either going to go up or down. Either way, what happens in this scenario is not good for IUL on a long-term basis. It is a bad future for them. And what I would say is, because of that fact, and because of the fact that we're looking at the fact that if you believe, especially if you believe interest rates are going to go up, if they're going to be down, if the interest rates go down, I would argue that whole life will have a little less performance as well. You'll at least have stability, right? And that'll be okay. I mean, it's not going to be amazing by any stretch of the imagination. It'll be better than a bond. That's what I'll say, long term. It'll be better than that. But if interest rates go up or stay in the elevated range that we're in right now, I would bet that your whole life policy is going to outperform IULs over the next 10 years or so, and even longer, because of the fact that we have this, you're capturing the gains and all the things that I showed. So if you're just getting here, make sure you watch a replay. Joe C, don't we get 4 to 5% returns in an IUL over the next 20 years? No. I'm curious where you came up with that. But no, the answer is you do not get 4 to 5% return in an IUL. Nothing is guaranteed in an IUL. And so there's nothing guaranteed. And so it's really dangerous. I'm looking at, and I say dangerous, like whatever, I guess a little emotional in my languaging there. But over the next 10 years and over the next couple of years, I look at the world we're in, when I look at my values and my beliefs and where I think the world is going, and I look at the inflation, and I think inflation is going to rear its ugly head again. I think we're not out of the inflation woods. I think we're going to go into a recession. And so if we hit a recession and interest rates go up, and we hit a recession, the markets go down or whatever, is that going to be really good for IUL? No, it's not, because it doesn't matter what the cap is or whatever. You're not going to be getting anything. You're going to have all the expenses and charges and all that stuff. Now, is it better than having a lot of money tied up in investment accounts? Maybe for a short period of time, sure. But then I've done all sorts of other videos on why IUL is really, really dangerous due to the loan risk in retirement for the tax-free income and retirement element of the game. And so you just have to understand that there's so many moving parts to these policies that you have to understand to be able to break down and assess and understand before you do anything. All right, here we go. This is going to be a good one. Why do people say IULs can perform well if you structure them properly? What do they mean? Or is this a marketing tactic? Yeah, so here, I'll do this. I'll go back to the board for a sec and I'll explain that. That's kind of an easy thing that won't take too long. So there's something that agents do, IUL agents do. So there's a guideline level premium, like a guideline premium test that they call. And so typically they use a guideline premium test when there's option B, right? And which is increasing death benefit, which is what most agents do to jam more money into the policy. And so there's different types of premium. And every company is a little bit different, but they have a minimum premium for some companies. They have a target premium. They have a MEC premium, and they have the guideline level premium, which is basically when people say we're going to max fund the policy, this is what they're having you fund it at, is the guideline level premium. And so what's going to happen is this is going to shorten the time that you pay, which is theoretically a good thing, even though it doesn't mean that once your premiums hit $0 on the illustration, it doesn't mean there's no cost. It just means the policy is pays the premium from behind the scenes. The target premium is what your insurance agent makes their commission on. What I see a lot, the minimum premium is the minimum premium to keep the policy in force. If there are certain riders, like guaranteed policy to be enforced for 20 years or something like that, you have to have that. And the MEC is always based on the 7-pay test. And this is a much more, they have it on IUL. It's much more applicable for whole life, less applicable for IUL. The guideline level premium is the test that comes into it. And so that's how they do it. So when you pay the premium, almost 20%, let me see here, almost 20% goes towards charges and fees. In order to break even, market performance has to be 30%. It just depends. It depends. If they, so, as far as this question goes, there's no guarantee that the fees are going to be 20 to 30%. It depends on your age, depends on how it's funded, how the policy is structured. If you use the GLP, your guideline level premium, you are in a situation where, yeah, I mean, when you take in, I didn't even count surrender charges, right? Like Doug Andrew does this stuff a lot where he's like, he funds it for 5 years. And I mean, I've got a person right now that reached out, was a Doug Andrew client, and he's like in his 70s. Doug sold him an IUL in his 70s for 5 years at like $100,000 a year. And now the guy put $500,000+ into it, and he's got barely $400,000 liquid. And because of the surrender charges, the accumulated value of the policy is just fine. There's not a problem. It's okay. I mean, it's not great. It's not ahead, but it's not like so detrimental. It would be, he's put say 500 in, and I think his accumulated value is like 470 or something. And in his mind, he'd walk away from 470, but the surrender charges still have the surrender value at just above 400,000. So he's got a lot more in surrender fees that go along with it that keep him tied up. And so it's not just the charges and what's in the accumulated value. You got to talk about like what's the surrender value and the surrender charges keep you handcuffed, right? And what happens is there's a lot to it. That the longer you go out, the surrender charges go down, but that's because they have more control and they know they have you kind of stuck, and they keep you stuck in these things, and it's just gross. It's just gross. Jonathan says, curious if they get if they give a benefit like a 0.5 percentage point floor, is it because they're charging extra for it? I know nothing is for free. Well, no, I mean, your instincts, your intuition there is perfect. It's spot on. Nothing is for free. There's always a cost to IUL. Everything is actuarially driven. IUL is the same as whole life. I'm not trying to say, whole life doesn't come without its costs and fees. We got to stop thinking about costs and start thinking about value, right? Start thinking about what problem are you trying to solve with this product. They use a lot of these hyped up little benefits like the 50 basis point floor and or even just the floor in general, and like the no capped indexes. That's like, doesn't matter if it's a no cap index. There's always elements like the no risk rate and the spread charges and different things in all of these indexes that are involved. The low volatility engineered indexes that look really good. They're low volatility, but somehow they illustrate better because they put these bonuses on, but they add more charges on behind the fact. And so they illustrate higher, but they don't perform as well in real life. And so like, it's all these things that kind of come into play that people just don't realize, right? 100% of the illustrations are wrong. 100% of the time, illustrations are junk. It's wrong the moment it's printed. Josie, 100%. And by the way, that goes for whole life and IUL. That's why I gave my example of showing how do they calculate the current illustrations on a whole life policy. At least with a whole life policy, you can deduct, do I think dividends are going to go up? Do I think they're going to go down? Compared to what? Remember, those are the three biggest words of personal finance. Compared to what? Compared to what they are now, do I think they're going to go up or down? If I was selling you a whole life policy in 1985 and you expected the current assumption to work when the dividend rate that is assumed is over 12%, you're going to be disappointed with the results, right? It's just as bad back then. That's why a lot of people like Art Williams and Dave Ramsey and Susie Orman built bad kind of juju about what whole life is, because a lot of people were selling it and not explaining it, right? Like you really got to explain this stuff. You got to understand this stuff no matter what you're doing. But in this environment, compared to what, I think dividends are going to go up. That's my take. I was not even talking about surrender charges, premium loan, cost of insurance, admin fees, rider charges, etc. 20% for the first 15 years depends on the care. Yeah, it's disgusting. Like there's no way around it. I got nothing. You got it, man. You should comment more often. You got it nailed. Good job. If clients want something similar to an IUL, would it be a fixed index annuity? Be better as it relates to retirement? So fixed index annuities can be great, but they're not accumulation vehicles. They're horrible accumulation vehicles. A fixed index annuity is phenomenal for somebody who's, say, 55 to 65, who, and this is just my opinion. Different people have different opinions about this, and I'm not as polarizing on this as I am against IUL. But if I were to, I'll tell you this, the only way I sell fixed index annuities is for the riders, the income riders, right? And so what can happen is you can guarantee roll-ups and you can guarantee income distribution out of them utilizing the income riders. So the only way I sell these things is if I know they're going to use them for income in retirement, and I know I can lock in a very specific result, because then we can plan around that result. And usually you use a portion of the retirement income inside of an annuity, and it opens up freedom and flexibility with other assets to do other things, because you can guarantee a specific result with this one product, and usually you're able to get a lot more out of that product than you would, say, with the 4% rule, right? Like there are annuities right now that the annuities that are out there right now, you can get 7.5% distribution with people that are starting at 67 years old. You can get a 7.5% guaranteed distribution. So if you got $1 million, you can kick out $75,000 a year of income, which if you look at the 4% rule, it's only 4%, which is $40,000. So you're talking about almost 2 times the annual income, right? And so it's pretty awesome. So I do like that, but I do think you have to be, the roll-ups on the fixed index annuities are typically about 10 years. And so with that said, I like to be within 10 years of retirement, because you can't roll them up. I mean, you can't roll it up longer than that, or it doesn't typically make sense to roll it up longer than that. And so I only like to use annuities for the guaranteed income riders. That's just me. Some people like to use them for accumulation in different areas. My experience is, anytime I've seen anybody try to use an annuity for any purpose outside of the income riders, they've been let down. That's so. And out of the gate, when I first started in the career, I sold a couple of people, index annuities for accumulation, and they didn't work out, right? They just didn't work. And so now the people didn't get hurt the same way they would get hurt in an IUL. But once again, compared to what they were expecting, they were let down. And I felt like a piece of trash, right? Because I thought they were a much more predictable thing than they actually were. And so that's the challenge. And so you just need to understand what you got going on. Got 100 IUL illustrations that you'd like to break down with me. All right, well, let's start with your first 3, Jonathan. Email them to chris@life180.com. Send them there, and I'll go through 3 with you, and we'll break them down. And we'll go through that. Maybe I can have you come live, and we'll break down a couple illustrations, and you can ask questions, and I could just coach you live on a channel. That might be fun. Give me a thumbs up if you're down to do that. We can have fun. When the fees are 20+% for any instrument, in order to break even every index, yeah, it must be 30% plus for 15 years. But illustrations always show very good numbers to sell the product. Yeah, that is the way it is. That's the reality. Unfortunately, there's no way around it. So, yeah, guys. I mean, did this help? Did anybody ever think about it like this? Because I know I've kind of like thrown this stuff and woven it into other videos from time to time, but like this. You got to understand this little chart, this metric about how interest rates going up or down or staying the same, and then what happens to all the moving parts inside of an IUL, thinking about the cap rates, thinking about the general fund and the options budget, and thinking about what's actually going to happen to the stock market and the economy, the indexes. What's that going to be? How's that going to perform and react? Have I ever had, this is a great question. The answer is no. I invited Brian. So if you guys don't know, Money Mythbuster is not an IUL expert. I'm going to tell you that right now. Did you guys just watch a video I did blowing up his scammy short video? It's on why to put $1 million. Why would somebody put $1 million a year into an IUL? It's insane. It literally is insanity. And it's straight up fraud. I don't know how National Life Group, which is the company that he used, allows him to do that publicly. But the answer is, James, I've got Brian. I just bought a hotel down here in the Dominican Republic. This is where my studio is. As my daughter keeps banging in and interrupting me. My studio is up kind of overlooking the jungle and the ocean and everything, even though you can't see it. My view is really nice. She's like, the pool area is all right up here on the cliff. And Brian Jarrell is going to come down here, and we're going to have a couple days of content creation and doing a debate and doing other content creation because he disagrees with me. I actually, I had an engagement with Carson Porter back and forth. I don't really have a beef with Carson at all. He and I had a back and forth on like WhatsApp or whatever it was, or Facebook Messenger, whatever. But I'd have Carson, I'd have Brian. I've debated. I've challenged Doug Andrew to a debate. He cowers away into the corner like a cockroach. David McKnight did a video on me, telling me rebutting my things on IUL, and then I made a video back on him with his favorite company, and I broke down an illustration. And I challenged him to a live debate. I live in the Dominican. He lives in Puerto Rico. I could literally take a boat to his house pretty much. And I've told him I'd pay for it all. And David he refuses to do it. So the thing is, all these people like to chirp about IUL. They like to talk about it. They like to talk about like it's the best thing. Very few people are able to like back it up. And the thing is like, I'm going to have Brian on. We're going to do a debate. Right. And a lot of people think I don't like Brian because he's always commenting on my thread. And sometimes I get pretty heated with him because Like, I just don't agree with him. But I actually like Brian. I think he's a good guy. I think he means well. I think he doesn't know what he doesn't know. And my problem is my problem with Brian, just in general, and he may be watching this, is just that he's only been doing this for a couple of years. And so it's a lot of theory, a lot of hypotheticals, and there's no real track record of people that have successfully done what he's selling to do. And if you have no real track record, no real world success of track records, then why are you going to do it? One of the first things I learned in business to get successful is, if you want it. And my first mentor, Jim, he told me, Chris, you want to be successful? Find the people that have the life that you want and emulate what they did to get there. I cannot meet one person that said, hey, Chris, you know what? I had an IUL and I utilized it in this way, and boom, all my dreams came true. I can't find one person even that has successfully funded an IUL and used it for income, right? I can't find one that's used it successfully for income for 10 years in retirement. So if there's not one real world living example of that, why? It's not called planning, it's called speculating. And I don't know about you, but I don't speculate with life insurance. It's just not what it's there for. So, all right, James B, you got some comments. Here we go. You want me to have Carson Porter on? I will have Carson Porter on. If somebody talked to Carson Porter, tell him I had a good video here, talking nicely about him. I'd love to have Carson on. Have Carson come down to the Dominican. Going to the DR in 3 weeks. The Hyatt, Zilara. That's Punta Cana. I'm on the other side. I'm in the jungle. If you look up Samana, you can look up Samana. And actually, I'll tell you what, I'll do this just for fun. If you guys want this, just for fun, give me a little plug. Oh, hold on. I'll find something here. Hold on. I'm gonna send you the link to my hotel that we bought, so you can check it out. It's kind of fun. And I will share, copy link. All right, I gotta get this. And so this is the hotel that we're in. Anybody ever wants to come down, wants to stop by, come on down, do some stuff. It's fun. But yeah, no, Hyatt's beautiful. I am out of the US for now. We didn't sell our house, but we're seeing how it goes for now. We're taking at least 18 to 24 months down here to get things going, and we're going to see how it goes. I think it's going to be good. I am out of the USA right now, yes, and so yeah, I don't know what to say to that. It's not a permanent thing. I still go back and forth to the US. Like, I'm going to be in the US pretty much all of June and some of July. And then I come back here to work on some development. We're building some more villas on the hotel, and we're expanding, and we're turning the whole entire hotel into a retreat center. I'm raising money for it right now. I launched a private equity fund. If you go to Cashflow Hacking, I'll give this. If anybody that's an accredited investor that is interested, we launched Cashflow Hacking. It's a private equity fund, and we're raising money to do all this down here. But I found this hotel. I wasn't looking to get out of the US. I'm not one of these extreme people that's just like looking to expatriate. Even though I got to tell you, ever since I've been down here, I feel a lot more freedom than I ever felt in the US. But I will say this, is that the opportunity down here is like nothing I've ever seen. And the property and the hotel, and if you get on this property and you see it and you see the value and you see what it can do and the cash flow it can be doing, it is otherworldly. Jonathan, it's exciting to have you on the team, man. I hope your interview with Matt went well and all that stuff, and it's super cool. I love having excited people join. I love having people that are really passionate about helping people for the right reasons on the team. So I think you're going to be a good fit. But like, I found the opportunity down here, and it was just kind of like one of those things where I couldn't say no to it, and I did. And so come on over anytime. Just let me know. As long as we don't have a retreat here and we got rooms, just I'll get everybody a little Life 180 discount for being here. So, or a good Life 180 discount, and we'll go from there. But all right, guys, speaking of that, it is 6:40 my time. Dinner is downstairs at the hotel kitchen restaurant in about 20 minutes. So I got to go hang out with my family. I get to go hang out with my family, I should say. Haven't seen them all day. My 5-year-old's been banging on the door over here at the studio. So I'm going to roll. But hopefully everybody found value in this. If you did, please like it, share it, get it out there to people. If you're here for the first time, or maybe the second time, subscribe, hit the bell. That way you're notified every time I launch a new video. I got a couple good videos coming out. I keep I'm on this little, yeah, man, I love it. I'm on this tear right now with this IUL stuff because there just seems to be so much chatter about it in all these Facebook groups and online and Instagram reels and TikTok, videos and YouTube shorts. It drives me nuts. And so when I see it, I have to create content to counter it, because there's got to be as much noise on the other side. Otherwise, people are going to get scammed out of their money. It's just the reality. And so you can see it's getting dark behind me. The whole background's changed since we started this video. That's one part about the studio that I find funny when I film this time of day. But all right, folks, it's been fun. Thanks for hanging out with me for the hour. I love this. There's really doing these live videos is one of the more fun things that I do. So appreciate everybody that's been here hanging out with me. And till next time, have